Preparing for a financial analyst at Liberty Mutual interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Liberty Mutual? I am attracted to Liberty Mutual because insurance combines finance with real-world risk management. A financial analyst can influence pricing, claims planning, capital allocation, and operating decisions rather than simply reporting historical results. I would bring strong Excel, accounting, and communication skills, while learning how underwriting performance and investment income shape profitability. The company's scale also offers exposure to different lines of business and meaningful opportunities to turn analysis into better decisions. While answering, connect your analytical skills to insurance economics, mention Liberty Mutual's broad property and casualty platform, and explain how the role combines financial analysis, business partnership, risk awareness, and customer-focused decision-making. Question 2. What are the three financial statements, and how do they connect? The income statement shows revenue, expenses, and profit. The balance sheet shows assets, liabilities, and equity, and the cash flow statement explains changes in cash. Net income increases retained earnings, while ending cash links the cash flow statement to the balance sheet. For an insurer, premiums and investment income affect earnings, claims reserves affect liabilities, and investment purchases affect cash and assets. Understanding these connections helps me identify whether reported growth is economically sustainable. Make sure to cover the income statement, balance sheet, and cash flow statement, explain retained earnings and cash reconciliation, and relate the linkage to an insurer's premiums, claims reserves, investments, and capital position. Question 3. What is the combined ratio, and why is it important for an insurer? The combined ratio measures underwriting performance by adding the loss ratio and expense ratio. A 95% ratio means the insurer spends 95 cents on claims and expenses for every premium dollar, producing a 5% underwriting margin before investment income. I would analyze trends by product, geography, and accident year, while separating catastrophe losses and reserve development. A ratio above 100% can still coexist with overall profit if investment income is strong, but it signals underwriting pressure. In your answer, define loss and expense ratios, explain that a combined ratio below 100% indicates underwriting profit, and distinguish underwriting results from total profitability including investment income and catastrophe effects. Question 4. How would you analyze Liberty Mutual's revenue and profitability? I would begin by decomposing premium growth into pricing, exposure, retention, and new business. Then I would evaluate loss ratios, expense ratios, catastrophe impacts, reserve development, and investment income. I would compare actual results with budget, prior periods, and management expectations, asking whether changes are recurring or temporary. Finally, I would connect the findings to profitability, capital needs, and business actions, rather than presenting isolated variance percentages without explaining their operational drivers. Be sure to mention premium growth, rate and exposure changes, retention, loss and expense ratios, catastrophe activity, reserve development, investment income, and comparisons against budget, prior periods, and relevant peers. Question 5. What is the difference between earned premiums and written premiums? Written premium reflects policies issued during a period, while earned premium reflects the portion of coverage provided during that period. If Liberty Mutual writes a 12-month policy in December, most of the premium remains unearned at year-end and is recognized over the coverage term. That timing difference makes written premium useful for measuring current sales momentum, while earned premium better matches revenue with exposure and claims. I would use both when analyzing growth and forecasting results. Focus on the timing distinction, explain how written premiums reflect policies issued while earned premiums recognize coverage provided, and discuss unearned premium reserves, seasonality, and their effect on forecasting revenue. Question 6. How would you forecast insurance claims expense? I would forecast claims using exposure volumes multiplied by expected frequency and severity, then adjust for inflation, litigation, weather, repair costs, and portfolio mix. I would review historical loss development triangles and actuarial indications, separating current accident year estimates from prior year reserve releases or increases. I would also build base, adverse, and favorable scenarios for catastrophe activity. Collaboration with actuaries and claims professionals is essential because the model needs operational judgment, not just historical averages. Make sure to cover exposure volume, frequency, severity, historical loss development, inflation, catastrophe assumptions, claims trends, reserve changes, scenario analysis, and appropriate collaboration with actuarial and underwriting teams. Question 7. What is loss reserve development, and how would you interpret it? Loss reserve development is the change in estimated ultimate claims costs for prior accident years as new information becomes available. Favorable development reduces current period claims expense, while unfavorable development increases it. I would assess whether the movement reflects genuine better experience, conservative initial reserving, claims settlement changes, or emerging inflation and litigation trends. Repeated unfavorable development could indicate pricing or reserving problems. I would separate development from current year performance to avoid misreading operating trends. In your answer, explain that development compares prior estimates with current assessments, distinguish favorable from unfavorable development, and discuss impacts on earnings, reserve adequacy, underwriting credibility, and future forecasts. Question 8. How do rising interest rates affect an insurance company? Rising rates generally improve future investment income because maturing assets can be reinvested at higher yields. However, existing bond prices decline, creating unrealized losses and potentially affecting accumulated other comprehensive income and capital. The impact depends on portfolio duration, liability duration, asset-liability matching, and accounting classification. Higher rates may also change policyholder behavior and claim discounting assumptions. I would distinguish temporary market value volatility from realized losses and long-term economic performance. Discuss higher reinvestment income, bond price declines, duration and asset-liability matching, unrealized losses, policyholder behavior, discount rates, and the distinction between accounting volatility and economic value. Question 9. How would you evaluate an insurance company's investment portfolio? I would evaluate the portfolio by asset class, duration, credit quality, yield, liquidity, concentration, and sensitivity to rates and spreads. I would compare asset duration with expected liability cash flows to assess matching risk. I would also review realized and unrealized gains, impairments, regulatory capital effects, and stress scenarios for credit and interest rate shocks. The objective is not simply maximizing yield. It is generating dependable income while preserving liquidity, solvency, and alignment with policyholder obligations. Be sure to mention asset allocation, credit quality, duration, yield, liquidity, concentration, market value sensitivity, regulatory capital, asset-liability matching, and the trade-off between income generation and risk control. Question 10. Tell me about a time you found an error in financial analysis. In a monthly reporting project, I noticed a revenue variance that did not match the underlying transaction volume. I traced the issue to a duplicated data extract, reproduced the error, and compared the corrected output with the general ledger. I informed my manager promptly, explained the financial impact, and helped update the checklist so the extract was reconciled before distribution. The experience reinforced that analytical accuracy depends on disciplined controls and constructive communication. Focus on the situation, your validation process, root cause analysis, communication style, corrective action, control improvement, and quantified or clearly explained impact without blaming another person. Question 11. How would you explain a complex financial result to a non-finance business leader? I would start with the conclusion in plain language, then explain the 2 or 3 drivers that matter most. For example, instead of saying the combined ratio increased by 300 basis points, I might say claims costs rose faster than premium after severe weather events. I would use a simple bridge or chart, quantify the impact, and finish with the business implication and recommended action. I would invite questions and confirm that the message supports the decision required. Make sure to cover audience awareness, a concise headline, operational drivers, visual support, relevant metrics, implications, recommended actions, and confirmation that the listener understands the decision required. Question 12. What financial KPIs would you monitor for Liberty Mutual? I would monitor written and earned premium growth, retention, new business, rate adequacy, loss ratio, expense ratio, combined ratio, catastrophe losses, and reserve development. I would also track investment income, operating income, return on equity, liquidity, and capital ratios. The key is interpreting the relationships. Premium growth without adequate pricing may destroy value, while a temporary catastrophe spike may not indicate structural weakness. I would review metrics by segment to identify where management action is most valuable. In your answer, discuss premium growth, retention, rate adequacy, combined ratio, loss and expense ratios, catastrophe losses, reserve development, investment yield, operating income, capital, and return measures. Question 13. How do you build a financial model, and what checks do you include? I begin by defining the decision the model must support, then organize historical data, assumptions, calculations, outputs, and checks into separate sections. For an insurance model, drivers might include policies, premium per policy, frequency, severity, expenses, and investment yields. I include balance checks, reasonableness tests, error flags, sensitivities, and clear documentation. I keep formulas transparent and avoid unnecessary complexity so another analyst can review, update, and challenge the model efficiently. Be sure to mention purpose and assumptions, historical inputs, operating drivers, forecast logic, scenario flexibility, balance checks, error tests, sensitivity analysis, documentation, and reviewability for other users. Question 14. What is variance analysis, and how would you perform it? Variance analysis explains why actual performance differs from a benchmark such as budget, forecast, or prior year. I would quantify the variance, decompose it into volume, price, mix, timing, and one-time effects, then validate the explanation with operational data. For example, premium could exceed budget because of exposure growth, while profit still misses because severity increased. I would prioritize material variances and conclude with whether the forecast or business action should change. Focus on comparing actual results with budget, forecast, and prior periods, decomposing price, volume, mix, timing, and one-time effects, validating drivers, and translating findings into management actions. Question 15. How would you assess whether an insurance product is profitable? I would estimate lifetime premium, expected claims, acquisition and operating expenses, reinsurance costs, taxes, capital usage, and investment income. I would test profitability by segment and scenario, including changes in frequency, severity, retention, inflation, and catastrophe exposure. The combined ratio provides an underwriting view, but I would also consider risk-adjusted return and capital consumption. A product can grow rapidly yet destroy value if pricing does not compensate for its volatility and required capital. Discuss premium adequacy, expected losses, expenses, acquisition costs, reinsurance, capital requirements, investment income, retention, persistency, catastrophe exposure, and profitability measures over the full policy lifecycle. Question 16. What is the role of reinsurance, and how does it affect financial analysis? Reinsurance transfers part of an insurer's risk to another carrier, helping protect capital and reduce volatility from large or catastrophic losses. Financial analysis should distinguish gross results from ceded premiums, recoveries, and net claims, while considering attachment points, limits, reinstatement costs, and counterparty credit risk. Reinsurance can improve resilience and capital efficiency, but it is not free. I would evaluate whether the protection aligns with exposure and whether the net economics remain attractive across stress scenarios. In your answer, explain risk transfer, catastrophe protection, ceding premiums, recoveries, retention, counterparty risk, earnings volatility, capital relief, and the importance of analyzing gross and net performance. Question 17. How would you prioritize competing requests from stakeholders? I would rank requests by decision impact, deadline, regulatory or customer consequence, effort, and dependency on other work. I would clarify the required output and level of precision before starting, then communicate trade-offs if priorities conflict. When possible, I would provide a useful preliminary view while completing deeper analysis. I would document assumptions and keep stakeholders updated, especially if data quality or timing changes. That approach protects relationships while ensuring the most important decisions receive rigorous attention. Make sure to cover urgency, financial materiality, decision impact, deadlines, data availability, stakeholder alignment, transparent trade-offs, interim deliverables, and communication when priorities or assumptions change. Question 18. Describe your experience with Excel, SQL, or other analytical tools. I use Excel for financial models, pivot tables, lookups, scenario analysis, charts, and reconciliation checks. I have also used SQL to join datasets, filter transactions, aggregate results, and investigate data discrepancies. My priority is building a repeatable process rather than relying on manual copy and paste. For example, automating a monthly data preparation step reduced preparation time and improved consistency. I would apply those skills carefully at Liberty Mutual, with strong controls around source data and model outputs. Highlight practical capabilities such as pivot tables, lookups, Power Query, sensitivity analysis, SQL joins, data validation, visualization, automation, and communicating how tools improved accuracy or reduced reporting time. Question 19. How would you handle incomplete or inconsistent data in an analysis? I would first identify whether the inconsistency is a definition issue, missing data, timing difference, or system error. I would reconcile totals to an authoritative source, quantify the affected population, and assess materiality. If information remains unavailable, I would document assumptions, use a reasonable proxy, and show sensitivity to the estimate. I would clearly label limitations and escalate issues that could change the recommendation. A transparent estimate is more useful than unsupported precision. Be sure to mention source validation, reconciliation, materiality, documentation, transparent assumptions, sensitivity analysis, escalation, alternative data, and avoiding false precision in management recommendations. Question 20. What would you do if your analysis contradicted a senior stakeholder's expectation? I would avoid treating disagreement as a personal conflict. I would recheck the data, formulas, definitions, and assumptions, then walk through the analysis with the stakeholder and ask what evidence supports the alternative view. If both interpretations were plausible, I would present sensitivities and explain the decision implications. If my work was wrong, I would correct it quickly. If the evidence remained strong, I would respectfully stand behind it and document the conclusion. Focus on respectful challenge, evidence quality, assumption review, alternative explanations, clear documentation, sensitivity analysis, and willingness to revise your conclusion when facts support a different interpretation. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.